Well, I haven't been very good at keeping time. No match for these guys. But I just wanted to introduce Gene Flood, the star of the evening, if you will. This is a man who does it. He lives it every day. He's president and CEO of Smith, Breeden & Associates. Gene, thank you.
Good evening, everyone. You've heard a lot of material already tonight, and I want to make sure that we have some time for questions. So I'm going to cut down my comments some, and then we can talk some more during the Q&A part. You know, I run an investment management firm. We trade all of these things that you've been hearing about tonight. So subprime mortgages, agency mortgages, corporate bonds, CDS, you know, every single thing that you've heard talk about tonight is what we trade. We manage accounts on behalf of institutions. So our clients are central banks around the world, insurance companies, pension funds, endowments, all of the people who are investing in these markets. I've been with this firm for 7 years. Before that, I spent about half my career on Wall Street with Morgan Stanley, trading these same things. And then before that, I was on the faculty at the Stanford Business School teaching about, most of these things weren't invented then. So a lot of this is new. And I've been in the fray helping to create these things and then valuing them and using them every day. So it's been a very exciting period over the last 18 months. It's just been, actually, exciting is probably not the right word. I'd say chaotic. I mean, it really has been different than anything that we've lived through before. So having gone through the crash of '87 and traded that as in proprietary trading at Morgan Stanley, or through Russia default, or the long-term capital management collapse, or any of those things, are kind of been like a play date compared to what we've been going through recently. You know, we have a framework that we use that as we think about this. And we break up the issues that we're dealing with these days into 3 categories. First is what's driving things: fear and lack of confidence. That's one area. Second area of what's been pushing this market around is the whole deleveraging. And you've probably heard that term in the newspapers or by commentators on TV. You may have heard me talking about it on CNBC. But I'll explain what that is, the deleveraging, and why it's important. And then the third thing is the economic cycle. So I just want to make a few comments about each one of those areas. What's causing that issue to be so important, how it gets reflected in prices, and then just a couple of comments about the various policy initiatives and to what extent are they helping. And then I'm going to sit down and we'll all field questions together. Let's just start off with the fear and the lack of confidence. What started that? We heard about counterparty risk. And it really, think of it this way. It's, if you're a bank and you're trying to decide how much to charge on a loan when you're lending money to somebody else, say another bank, if you don't know what that bank holds on its balance sheet, so what do they hold and what kinds of securities? They hold all these different types of securities. Well, how risky are those securities? How much of them do they hold? And where do they have them marked? Have they marked them all the way down to where they should be? Or are they way too high and they still have to drop those prices and then might not be able to pay you back? right? That's the counterparty risk issue and the lack of transparency. And so with that, what happened was, like at the beginning of last spring, when that started happening, banks stopped lending to each other. And then companies that needed cash said, oh, well, I need to go to the bank to borrow it. I can't do that because the banks aren't lending. I better sit on all the cash that I can collect. And so all the credit markets just started to close down because of that. Now, the way that showed up in prices was this term LIBOR, the London Interbank Offer Rate, the rate that banks lend to each other. Typically, that's pretty close to a risk-free rate. Pretty close, not exactly, but pretty close. What happened was those rates just started going up, 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 up. And they went up, so they were up at around 4%, over 4%, almost 5%. And Treasury rates were very low. You know, Treasury rates right now, federal fund rates, are 1.5%. Now, the government has been trying to get those markets working again, and so they've been pouring water in there. And we heard about the FDIC and how they have been guaranteeing bank deposits, so deposits, savings deposits that you or I would put in the bank. They've been guaranteeing bank debt. They've been doing everything that they can, both here and then their counterparts in Europe, to try to get lending going again. We've also heard about the commercial paper market, and one of the speakers spoke about that. That is short-term lending that people do with corporations. And that market has also started working a little bit. So the LIBOR rate has come down about 1%, so we've gotten some movement there. Commercial paper market has also started. So this is short-term lending to companies. If you went back 3 weeks ago, the longest most people would do that lending for is, guess how long? Does anybody know? How long? Overnight. Right? That would be almost the longest that you could get people to lend to corporations on a short-term basis, just overnight. A little bit, sometimes out to a week. Well, now we're starting to get some movement again, and we're getting movement out to about 1 month. We're still well short of the 3 months and sometimes even out to 9 months that we used to have. But at least now we've got lending that will go out 1 month. So we're getting a little bit of movement there. The other thing that has happened is there's discussion about, started to have lots of difficulty as well, because what happens is that unlike the stock market, if you go and you buy stocks and you work with an exchange, if my company wants to take a position on what's going to happen to, let's say, General Motors, we can make a bet with another company, let's say PIMCO. You know, Smith Breeden makes a bet with PIMCO saying, I think General Motors is going to run into problems. And PIMCO says, I don't. And so we'll write a contract with each other where the value of it goes up and down with General Motors stock or with General Motors bonds, right? But now I've got PIMCO's credit risk and they have mine. And if they can't see enough about what's going on my balance sheet, then they're taking my credit risk and they get worried. And if that's happening with lots of us at the same time, then we all just step away and we say, no, we don't want to bet, and everything starts to shut down. So in order to get around that now, there's discussions about putting an exchange in between so that PIMCO would sit on the other side of the exchange and I'll sit on this side, and then I can still make that bet with PIMCO, but every day I have to settle up money. If I gain some, then PIMCO has to pay the exchange, and the exchange will pay me, or if it goes the other way, I do that. And that way, we keep the amounts of the bets relatively small, and if PIMCO defaults, I've still got the exchange in between us, and so that provides a lot of safety. So we've got some movement there, and we don't have that exchange yet, but we're talking about building such an exchange. So where are we on that fear and lack of confidence? I'd say that the market is still about 75% frozen. It's still very hard to borrow money. It's still very hard to do most of the transactions that we would like to do. The second topic, let me cover that a little bit more quickly, deleveraging. What's going on there? What happened is that it all started with housing prices going down. And the housing market started to get soft in the middle of last year, spring of last year. Then all these bonds that Chris was talking about that are based off of houses, the prices on those bonds started going down. Now, think if you're a bank and you've got these bonds on your balance sheet that have gone down, and you have to have capital to go to support these positions. If the prices of those go down, then the value of your balance sheet is shrinking, and you've got to do something about that. So you have to sell some securities to get cash back to support your balance sheet. Or if you're a firm like my firm, where we say we might borrow and then buy these securities, if the price goes down, then we have to put up more cash. That is, we have to meet margin that's being supported by the value of these bonds. Now, how are we going to do that? Well, we have to sell something else. And so you can see that you got banks doing this, you got broker-dealers doing this, you got investment managers doing this, so the prices go down, we have to raise cash, we have to sell something else, the prices go down some more, we have to raise more cash, we sell some more, and then all the prices of things that may not even be related to the housing market are going down because we have to sell whatever we can in order to meet margin. And so you've got prices across the market falling, all started by this problem in the housing market. But now prices are falling for things that are unrelated to houses. And so you've got this, that's why it's called, we had used leverage to get in these positions, now we've got to de-lever to get out of them, okay? And that's what this deleveraging phenomenon is about. Now, what happens to prices when that goes on? Take, for example, commercial mortgage backs, okay? They're not based off of the residential market, they're based off of corporate buildings, right? A lot of those, the US corporate sector is in good shape. So if you look at the loans on those, there's no defaults, there's no delinquencies on lots of them. But the interest rates on those went from about 1/3% above safe interest rates to 6% over. Never seen anything like it, right? These are so prices on these bonds were at 100, they fell to 70. But no risk, basically the risks hadn't changed. But they're being pushed by this deleveraging impact. And you see that going on across the marketplace. Now, how much have they come back? We've seen lots of these programs, right? 13 different programs that the Treasury, the FDIC, and the Fed have come out with over the last year and a half. The TARP and all these other things that we've heard about today. Those prices on commercial mortgage-backed securities, the spreads blew out from 1/3% to 6% over safe assets. They've come back to about 5.5%. Okay? So these prices are still under extreme duress. And so I would say, how far along are we on the deleveraging? We don't really know, because this cycle can keep going. There's no logical end to it. I mean, we can't point to anything and say, well, once that happens, no one else will need to deleverage, unless no one's holding anything with leverage. But that's not going to happen. But how long it's going to take, we just don't know. So we're not sure how far along we are on that. And then the last piece here is the economic slowdown, and I'll just stop with that. With the economic slowdown now, that all of these things have happened where raising debt has become much more expensive, these interest rates have gone up by so much, by the lack of credit availability, so my company needs to go and borrow money to do a transaction. Banks aren't lending. All of those things mean that companies are laying people off. They are investing in less equipment. They are selling assets that they had hoped to hold on to. So the real economy, because of all of those things, is slowing down. And we've heard different predictions about how dire that's going to be. We certainly think, my company certainly believes that we are going to have a recession, and it's going to be maybe not as bad as 80, 81, but it's going to be worse than the 1990 recession and the 2001 recessions. It's certainly going to be worse than that. How do we get out of those? What do we do? Well, we need some stimulus to go directly to the heart of the issue, which is the housing issue. So we need some kinds of capital infusion there, some incentives for people who are renters to buy homes. We're going to need some things to stimulate the economy directly, some more fiscal stimulus. We had the package last year, the $150 billion. Maybe we need another 150 or 300 billion more to help to keep us from going into a very deep recession. Now, people look at those numbers and they say, wow, those numbers sound pretty big. But just remember, the U.S. economy is really quite large. And what we're trying to do is we're trying to avoid the cost of having very high unemployment rates. So if the economy goes and it slows down by, say, in -2%, -3%, something like that, on a $12, $13, $14 trillion economy, that adds up very quickly. So if you could avoid some of that by spending $100 billion or $150 billion, it's definitely worth it. I mean, that's the trade-off that we're making as we look at the economy. Now, when you look at what's happened to security prices, and this is where I'll stop, what's happened to security prices now that the real economy has started to slow? Now you've got falling stock market, you've got emerging market debt, spreads blowing out, you've got investment grade corporate spreads blowing out, you've got high yield spreads going out, you've got leveraged loan spreads going out. So pretty much everything now is getting hit. And so that's where we need the policies that affect the real economy, this fiscal stimulus, for example. Those are the ways, that's what's going to deal with all of these other asset prices that are now getting hit, that go well beyond where it all started, which was the housing market. So where are we on that? We're just at the beginning, right? The last print that we got on GDP was 2%, right? The next one that we get might be -1, the one after that might be -2. So we're at the beginning of that cycle now. So that's the next piece that we're going to be working our way through. So, as I said at the beginning, I feel like this has, the Russian default and long-term capital management and the crash of '87, that was kind of like a play date compared to what we've been going through so far and what we've still got to work through. So let me stop here. I think we're going to get the speakers all up on the platform here, and then we'll field questions. And you got people who can cover a lot of different areas. So we'll look forward to some good questions. Thank you.